Next week, we get clues on the state of the housing market when Lennar reports earnings on Monday right here on Overtime. We're also going to get updates on housing starts and building permits for May. But in the meantime, housing research firm Zelman and Associates putting out a home building survey today, which shows home builder confidence dropping to its lowest level since January 2023. Joining me now is Zelman and Associates Executive Vice President Ivy Zelman. Ivy, welcome. So the bar, is it set low enough for Lennar earnings, given what you're hearing out there?
You know, I think that they'll have not a lot of good news to report. So I think the stock will likely come under pressure. And while they're doing things internally to reduce costs, I think they're probably taking staff down, headcount reductions, trying to take costs out of their direct building costs. I think that the demand environment is pretty tough. So I'm not expecting good news, but I think they're doing everything they can in a tough environment. What would good news be coming out of this environment? How should investors know when it might be coming? Well, you know, Lennar, as largest builder in the country, is really leading with a strategy to move inventory at whatever price they need to move the inventory. So that's really taking their competitors down as well. So I think if Lennar starts less homes and is looking for less absorptions, that could perceive to be positive news, which would mean less supply coming to the market. It wouldn't be good for the building product companies necessarily, but I think that we need to absorb so much spec inventory in the market before we're going to see demand resume or the competitive pressures be alleviated at all. I mean, what were you seeing in this survey with some of the policy impacts, immigration, tariffs? Any issues on supply of workers, or is the fact that the general environment isn't that great, is that helping in a way because it's not like they'd be building tons of homes anyway? Well, interestingly, the cost to build, the direct costs are actually under 2%, which is definitely the direction that they want costs to be going down. So they're not increasing despite tariffs and attempted price increases by their vendors. Part of that is they're able to negotiate push back on vendors because the business is very weak. So you're right. I also think when it comes to labor availability, they're really having no problem with securing labor. So the risk of deportation is yet to materialize as a factor. What we are seeing, though, are qualification issues and consumers that are unable to meet qualifications, even at a mortgage rate buy down as low as 4.99. Some builders are going down to 3.99, buying 30-year fixed. And that to me is concerning because that while they can qualify at 3.99, the fact that they couldn't qualify at 4.99 really looks like they're stretching to purchase this home. So those are things that concern me. You said availability of labor has yet to materialize as a factor. How much of that is regional, and do you expect it to materialize at some point? You know, at this point, with starts pulling back, our survey indicated that starts had the biggest pullback that we've seen in quite some time, down 10%. I think the weakness in overall supply coming is going to mitigate that as a factor, at least as of right now. I don't see it in the near term. I wouldn't say this year we're going to feel it. Probably something in 26 we have to be watchful for. Any impact from credit scores overall and student loans coming due again for folks? That impact, is that more of a first-time home buyer issue, which is a market that is in less play than it has been historically? You know, I think that we're concerned about the student loan credits getting dinged. Certainly, we haven't heard that student loans have been a real problem for the builders as of yet, but qualification and overall weak FICO scores are clearly already present, even without the student loan credit scores coming down. I do think that this is the future generation of home buyers. And while we have some student loans for people over 60, clearly students that are graduating now and have in the last few years are going to be challenged to buy homes. It might affect the rental market as well, as those students are going to be unable to qualify for rental availability, rental product. So it's not good for any of the housing shelter choices, really. So there's the idea out there that with oil prices higher, with this conflict in the Middle East, that might make it tougher for the Fed to cut rates. Is there an expectation, you think, in the industry around home builders that rates will come down? And so if the Fed doesn't make a move, that could hurt? I think that expectation has been pretty much diminished. I think people are adjusting to rates higher for longer, which is why when we surveyed the builders, we asked how many of them are actually reducing headcount. And I think 20% indicated they're reducing headcount. So I think they're at least contemplating higher for longer. And keep in mind, even if the Fed were to cut rates, they really can't control the long end of the curve. And we want to keep reminding people of that, because the long end is going to be dictated by, the fiscal debt issues and other factors and less foreign buyers. I think that the long end is going to stay higher for longer, and we have to live with that.